Welcome to an Introduction to Economics, brought to you by Parkbench Tutors and narrated by David Hopcroft. For further information about Parkbench Tutors, please visit parkbenchtutors.com. This podcast is our second on consumption and investment. Friedman put forward a permanent income hypothesis. It was an attempt to address the idea that the absolute income hypothesis does not take account of wealth and interest rates, nor did it fit with long-run series data. The hypothesis of Friedman is that permanent consumption, CP, is proportional to permanent income, YP. In other words, CP equals KYP, where K is a constant. The constant is equal to the average and marginal propensities to consume. This makes the hypothesis consistent with the long-run data that suggest APC is constant. Permanent consumption is the planned level of spending from permanent income. It may differ from measured consumption by unplanned temporary increases or decreases. C measured equals C permanent plus C transitory. However, it assumes that for a large sample the transitory income will average to zero. Some will increase and some will decrease. The permanent income hypothesis is C equals KYP, where K is a constant equal to APC, the average propensity to consume. The map illustrates the straight line when permanent income is now plotted against consumption, the slope giving the constant K. How does this idea help explain the short-run time series data? This model predicts that for a family with above average income, the average income will be greater than the average permanent income. Since average propensity to consume, APC, equals average consumption divided by average income, the measured average propensity to consume will be less than the long-run average propensity to consume. The reverse happens for families with below average income. The measured average propensity to consume will be greater than the long-run average propensity to consume. From this, we would predict that the APC of the above-average income families will be less than the measured APC for below-average income families. In a boom year, the measured average propensity to consume will be less than the long-run average propensity to consume. In a slump year, the measured average propensity to consume will be greater than the long-run average propensity to consume. So we predict that average propensity to consume will be higher in a slump year. This agrees with short-run data. An alternative explanation was provided by Duesenberry, with a relative income hypothesis. To explain cross-section data, he suggests that in a neighbourhood where income is relatively low, then consumers will spend to try and keep up with richer neighbourhoods. This was called the demonstration effect, and is more commonly termed keeping up with the Joneses. Duesenberry also suggests aggregate consumption depends on both current income and the highest level of income previously attained. As national income rises, then consumption rises along the long-run consumption line. If the national income falls, consumers will still try to maintain their level of consumption, so the average propensity to consume will rise. Investment is about 20% of expenditure in the United Kingdom. Classical economists see investment and interest rates as related. For a profit-maximizing firm, a potential investment in a new piece of equipment machinery involves looking at expected yield. Whether the investment is profitable can be estimated using either present value calculations or rate of return calculations. In general, the theory suggests that the lower the interest rates, the greater will be the amount spent on investment. There are problems with the theory. At a time of recession, it appears that investment is also closely related to business expectations and confidence. Secondly, if confidence is high, the investment may take place regardless of interest rates. And thirdly, it is difficult to calculate yields over a number of years. The Accelerator Theory proposes that the current level of investment will depend on income changes from the past. This is illustrated by the expression IT, the current investment, is equal to a constant called the accelerator multiplied by the change in national income from the previous period, YT minus 1. The gross investment will be equal to the current investment plus any additional investment being undertaken as replacement due to depreciation. The accelerator theory suggests if demand rises steadily, the investment increases, and if it rises at an increasing rate, then investment will do the same. If demand falls or remains constant, then investment will fall. The theory has been criticized because it assumes all machines are already at capacity, and that there is no possibility of using overtime or introducing shift labour for working. It also ignores the fact that demand could be temporary. If there is a very harsh winter, then demand for heaters will increase, but a business would not expect that demand to be increased yearly in the coming winters. It is reasonable to say that investment depends on interest, past and present national income, and business expectation. Given that investment is not an instant decision, the second of these expressions may be the more accurate. This ends our second podcast on consumption and investment, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and listening. We wish you success in your studies. For further information about Parkbench Tutors, please visit parkbenchtutors.com.